Bill Ackman is one of the most polarizing figures in modern finance. He's a billionaire hedge fund manager known for his aggressive activist investing, his massive bets that have both made and lost fortunes, and his willingness to publicly battle CEOs and entire corporations. With a net worth in the billions and a reputation that precedes him wherever he goes, Ackman has built an empire through conviction, controversy, and an unshakable belief in his own analysis. This is the story of how Bill Ackman made his money. William Albert Ackman was born on May 11, 1966 in Chappaqua, New York. His father, Lawrence Ackman, was a successful real estate developer, which gave young Bill early exposure to business and investing. Ackman attended Harvard College, graduating magna cum laude in 1988, then went straight to Harvard Business School, earning his MBA in 1992. At Harvard, he was already thinking like an investor, analyzing companies and developing the framework that would define his career. Right out of business school, Ackman co-founded his first investment firm, Gotham Partners, with a Harvard classmate David Berkowitz. They launched the fund in 1992 with just $3 million. It was a tiny fund by Wall Street standards, but Ackman had big plans. He focused on a strategy that would become his signature: activist investing. Instead of just buying stocks and hoping they'd go up, Ackman would buy significant stakes in companies he believed were undervalued or poorly managed, then push for changes to unlock shareholder value. Gotham Partners saw early success. Ackman made smart bets on distressed debt and real estate investments, and the fund's returns were impressive. By the late 1990s, Gotham Partners was managing hundreds of millions of dollars, and Ackman's reputation as a sharp, aggressive investor was growing. But his early years weren't without controversy. He became known for his willingness to publicly criticize management teams and advocate loudly for his positions, a trait that would define his entire career. One of Gotham Partners' most notable early investments was in Rockefeller Center. In the mid-90s, the iconic New York landmark was in financial distress. Ackman invested heavily in the property's debt, and when the restructuring played out, Gotham Partners made a significant profit. It showcased his ability to identify value in complex distress situations. But Gotham Partners wasn't destined to last. In the early 2000s, the firm ran into serious trouble. A large position in a company called Gotham Golf went south, and the fund suffered heavy losses. Making matters worse, investors began pulling their money out. By 2003, Gotham Partners was forced to wind down. It was a devastating blow for Ackman, both professionally and personally. He had gone from a rising star to someone whose fund had collapsed. Many people in his position would have walked away from the business. Ackman didn't. In 2004, Ackman launched Pershing Square Capital Management with $54 million, much of it from his own pocket, and a handful of loyal backers who still believed in him. The name Pershing Square came from the New York City location where his office was based. This time, Ackman was determined to do things differently. He would be more disciplined, more focused, and even more aggressive in his activism. Pershing Square would become the vehicle through which Ackman built his fortune and cemented his legacy. One of Pershing Square's first major wins came with an investment in Wendy's, the fast food chain. Ackman took a significant stake and pushed for the company to spin off its Tim Hortons subsidiary, which he believed was undervalued. The strategy worked. The spin-off unlocked enormous value, and Pershing Square made hundreds of millions of dollars. It was a textbook activist play, and it announced to the world that Bill Ackman was back. But Ackman's biggest bet during this period was on MBIA, a bond insurance firm. Ackman believed MBIA was insolvent and took a massive short position. He went public with presentations and reports detailing why he thought MBIA was doomed. It was bold and confrontational, making him many enemies. The trade took years to play out, and Ackman faced fierce criticism and accusations of market manipulation. But he held his ground, and eventually the trade paid off with substantial profits. Another major win came with Target. In 2007, Ackman took a stake and pushed for changes, including spinning off the company's real estate assets. While Target didn't pursue the full spin-off Ackman wanted, the pressure he applied drove the stock higher, and Pershing Square made significant profits. Ackman's activist campaigns became more high-profile as his success grew. He took positions in companies like General Growth Properties, a real estate firm that had filed for bankruptcy during the financial crisis. Ackman saw opportunity where others saw disaster. He bought a huge stake in the distressed company, believing that its assets were worth far more than the market was pricing them. When General Growth emerged from bankruptcy, the value of Ackman's position skyrocketed. Pershing Square reportedly made over $1 billion on the trade. It was one of the greatest comeback stories in investing. But not all of Ackman's bets have been winners. In fact, some of his losses have been just as spectacular as his gains. One of the most infamous was his investment in JC Penney. In 2010, Ackman took a large stake in the struggling department store chain and joined the board of directors. He pushed for radical changes, including hiring Apple executive Ron Johnson as CEO. Johnson attempted to transform JC Penney by eliminating sales and coupons in favour of everyday low pricing. It was a disaster. Customers hated it, sales plummeted, and the stock crashed. Ackman eventually resigned from the board and sold his position at a massive loss. Pershing Square lost nearly $500 million on JC Penney. It was a humbling experience for Ackman, a reminder that even the most confident investors can get it wrong. But rather than retreating, Ackman pressed on, looking for the next big opportunity. Then came Herbalife, perhaps the most controversial chapter in Ackman's career. In 2012, Ackman announced a massive short position on Herbalife, a multi-level marketing company that sells nutritional supplements. Ackman didn't just think Herbalife was overvalued, he believed it was a pyramid scheme that was defrauding consumers. He pledged to take the company to zero and went on a public crusade, giving presentations, appearing on television, and lobbying regulators to investigate Herbalife. The problem was, not everyone agreed with Ackman. Other famous investors, including Carl Icahn, took the opposite side of the trade, buying Herbalife shares and driving the price up. What followed was an epic public battle between Ackman and Icahn, complete with televised shouting matches and personal attacks. Meanwhile, Herbalife's stock kept rising, and Ackman's short position kept losing money. By 2018, after years of fighting and losses estimated at nearly $1 billion, Ackman finally threw in the towel and closed his Herbalife short position. It was one of the most high-profile and costly losses in hedge fund history. Ackman admitted he had been wrong, or at least that the trade hadn't worked out as he'd hoped. It was a rare moment of public humility for a man known for his confidence and conviction. But Ackman's story didn't end there. In fact, some of his biggest wins were still ahead. In early 2020, as the COVID-19 pandemic began to spread, Ackman made a prescient and enormously profitable bet. He purchased credit default swaps, essentially insurance against a market crash, for a relatively small amount of money. When the pandemic hit and markets collapsed in March 2020, those swaps became incredibly valuable. Pershing Square reportedly turned a $27 million investment into nearly $2.6 billion in profit. It was one of the greatest trades in hedge fund history. Ackman used those profits to buy stocks at depressed prices during the market crash, positioning Pershing Square for huge gains as markets recovered. The fund had one of its best years ever in 2020, and Ackman's reputation as a savvy, opportunistic investor was restored. He had gone from the Herbalife disaster to one of the most successful trades of the decade in just a few years. Today, Pershing Square manages billions of dollars, and Ackman's net worth exceeds $4 billion. His portfolio includes major stakes in companies like Chipotle, where his activist efforts helped turn around the struggling chain, Howard Hughes Corporation, and companies like Netflix and Domino's Pizza. Ackman's investment style is based on concentrated positions. Unlike many hedge funds that diversify across dozens of stocks, Pershing Square typically holds just a handful of investments at any given time. It's a risky strategy that can lead to massive wins or devastating losses. Beyond investing, Ackman has become a public figure, active on social media and appearing frequently on CNBC, sharing his views on markets, politics, and business. So how did Bill Ackman build his wealth? Through a combination of intelligence, conviction, and an almost unparalleled willingness to take risks. He's made billions by identifying undervalued companies, pushing for change, and betting big when he believes he's right. He's also lost hundreds of millions when his bets went wrong, but he's always bounced back, learning from his mistakes and moving on to the next opportunity. Ackman's career is a testament to the power of activist investing and the potential rewards of concentrated, high-conviction positions. It's also a reminder that success in finance requires not just intelligence and skill, but resilience, the ability to withstand public criticism, and the courage to stand by your beliefs even when the whole world seems to be betting against you. Love him or hate him, Bill Ackman has left an indelible mark on the world of finance, and his story is far from over.